carrying forward from the conversations we had in segment one about where things are on the Fed side, on bond side, it's always important to look at the volatility piece for bonds. And you can see that they're still remaining elevated. And just given the inability of the Fed to do QE while they're currently rolling out QT, is going to keep that volatility elevated. Because anytime that you've had a big spike in volatility, they've just issued a significant amount of quantitative easing, which has then brought that volatility back down. But now that they're beholden, they have no choice. And that's what we've been talking about for those that have been following us for so long, is the longer they did QE, the closer they got to no longer being able to choose if they wanted to do tightening or easing. And here we are. And now we're in a situation where, things are getting difficult again. The economy is struggling, and there's nothing that anyone can really do, where we finally have to accept that we didn't break the business cycle, that there is still a business cycle, and we're going to have to go through a painful down cycle. And the longer you try to prolong the quote unquote correction that naturally happens, the worse it gets, and the less tools you have to soften that landing. And I think that's one of the bigger issues when you look at a global perspective. And obviously, as that debt continues to be at a very volatile side, it's going to be difficult to see rates come down given where that volatility sits. The high grade sovereign credit default index continues to move higher when you look at just essentially where fear is. And this is on sovereigns. Like, you're looking at people panicking about what kind of protection do I have against a sovereign default? And especially when you think about the amount of debt that was issued between, March 2020 and December 21. There's a lot of new debt out there. There's a lot of new issues out there that is going to make this even worse when you look at the balance sheets of these sovereign nations. Treasury illiquidity and volatility near record levels, and that's the problem. And that's when we continue to talk about the illiquidity side, where there's the buyers and sellers, and as we talked about, there's more volume coming out there, but there aren't a lot of buyers, and that's where we continue to see a lot of these auctions go through the tail, creating a lot of this pressure to the upside on rates, on yield, and we don't see that stopping anytime soon, especially even though we did get a positive Jolts data, which we were going to talk about in a second. And then on a cumulative U.S. TIPS ETF, you see just a matter of the outflows when you look at where things are, because the 10-year TIPS yield, it should be, again, adjusted for inflation. And that's why we do see a lot of these movements higher when you start looking at, well, what is inflation going to look like? There's still this view and mantra that inflation's going to come down, but then you look at where, as we talked about in the EIA show yesterday, where's heating oil? Where's distillate? Where's gasoline? Crude has gone back up. That means that October is going to have some of that upside when you look at just the gasoline and diesel component. Where is food? And all of these components keep layering on top of each other, making things worse and worse. So then when you look at some of the data sets that came out, quit rates. So quit rates flatlined in August at 2.7%, but the big miss was in job openings. So the Jolts are a very volatile and unreliable measure of the state of the labor market. But Powell referred to the ratio of U.S. job openings per unemployed person as one of his preferred metrics to gauge labor market strength. But, let's track it. And so, yes, it fell. Obviously, it fell. But look at where it's falling from and look at where it has to go to. And then consider that we're still well below normal labor market participation. So even as openings drop, you still don't have a full labor market participation. So there was never enough people to fill the openings. So the fact that the openings are finally coming down, okay, but is this going to be the crux of what drives Powell to adjust and stop raising rates? Well, no, because when you look at inflation, it reaccelerated again. It grew month over month. We're at over 8% year on year. Core is over 6%. When you look at the median and all these different pieces, it's pulling us higher. So yes, this was a good number, but it's not the end all and be all. And there's also what we like to call bear market rallies, where everybody gets so short, so bearish, that it just takes that one nice little, oh, this wasn't as bad as expected. And then boom, you get this massive move up. But again, you have to look at it in context when you're evaluating the market in general. So then when you look at the challenger side, so there was 4 consecutive months of year-over-year increases in the challenger job cuts. Retail sector spiked, which is interesting in context for the coming holiday season, because typically people hire starting now for the holiday season, because November and December is big period. So is this telling us a different story when we look at, well, what is the retail sector doing? Is this going to get a bit worse? And that's when we lead into what we're going to talk about in the next segment of, are we seeing that slowdown in spending and those problems coming on? And again, this is something that is another good thing when you think about, the Fed finally starting to get in front of some of these different pieces. But then looking at it a bit differently, again, job openings, you can see just how far we have to go. And that quit rates, we need to see some of that accelerate. But then when you look at the JOLTS versus the private payrolls, which comes out tomorrow, and we'll obviously talk about it during the FSC show, it's the first indicator, but the Fed will not, does this mean that the Fed's going to hike by 1% instead of 1.2% by the end of year end? Maybe, but when you think about the risk of not doing enough is much greater than the risk of doing too much at this point. And you could say, well, Volcker was taking us to 22%. We're splitting hairs over 4.5%. So the leverage ratios have gotten so extreme that everyone's panicked at 4%. And not to say that they weren't panicked at 20%, but just hear that number, 4% versus 20%. And you get an idea of how absurd we currently are in terms of the sensitivity to these rates. Now, when you look at the asset securities held outright, mortgage-backed securities, treasuries, again, this is showing you that reduction of the balance sheet, and this is getting, again, pushed into the market. This is adding volume, which is driving down pricing, increasing yield and rates, which is what we continue to point to as that. Again, everyone likes to say, oh, well, inflation is slowing. There's going to be a recession. Therefore, rates should come down. What about just sheer volume? And again, they are not wrong to say that, if inflation is going to go down, rates go down. If there's going to be a recession, rates should go down because there's going to be an increase in demand for fixed income. But who is your incremental buyer? That incremental buyer is gone. And that's, again, where we continue to see that stress point. Non-financial corporate debt securities and loans as a percentage of GDP came down. Still, again, you can still see the amount of debt securities and loans as a percent of GDP is elevated, and things that are going to continue to normalize, especially as loan issuance plummet to and investors shun risk. Again, that's what we continue to see is, why am I going to issue a loan right now given where rates are? And do I want the risk? And that's where we continue to see a lot of this shrinking. And this should take some of that volume out, which is what you want to see. You want volume to come down to enable to have a bit more of a free moving economy and market. But again, they're so frothy. There's still so much wood to chop, which is why even as the Fed pauses, it's not going to reverse. And they're not going to make the same mistakes they made in 73 to 76, because as inflation was coming down, the Fed saw the trend and said, we can now start to ease because we've gotten in front of inflation. Things are working out. So now we can go and they got it wrong. And then instead of inflation continuing to go down, it absolutely reversed and then quadrupled, creating a wage spiral and all these other issues, which then Volcker tried to get in front of. So the real when you look at real disposable income per capita, has been essentially flat for most of the year after falling sharply the previous year, remains well below the pre-pandemic trend as inflation has continued to take, again, that huge bite out of incomes, which is why real disposable personal income per capita, when you look at below trend by 8%. So again, just so much pressure when you look at, well, this is going to bite. And when you look at inflation, when you look at savings, when you look at just price of living, there is a clear direction in which this is going to travel, with the private residential construction, again, starting to roll over, new single family homes, the one that's coming down the most, new multifamily, again, flatlining as home improvements still, starting to roll, but this takes time. And that's where we see a lot of this really starting to come down with the New York Fed. Now this is just showing the amount of froth that remains in the market, but also the amount of fear. Because if you're concerned about just getting your money back, well, I'm just going to park it here. But you're not getting the return at the bank. So when you think about the 70s and you could say, well, inflation was at 18%. It was, but you were also earning 15% in the bank. Now, inflation's 8.3% and you're earning 0.2%. So technically on the spread side, you're getting hit harder now than you were then. And that's when you start putting this into context, it becomes a much bigger issue when you look at, well, this is why, because there's so much money just sloshing around that you're not seeing rates go up. You're not, and banks have no incentive to pass it on to you, because where are you going to go? Who are you going to go to? Where in the past there were a lot of banks, there were a lot of smaller banks. They've all been consolidated. And even though part of 08 was making sure that there wasn't concentration, it's a lie. There's way more concentration now than there ever was before. And that is, again, creating those different issues. So then when you look at putting it all together, the U.S. CEO confidence, the low earnings recession discount, the first phase of the bear market, the earnings, the earnings shifts, there's so much that is still yet to come as we see a lot of this pressure to the downside, as we showed in segment 1, with the difference between assets and stock market versus GDP, and where there's going to be that bigger correction. So then when you look at ISM manufacturing consumer prices, there should be some of that movement lower. But when we talk about commodity prices, even though demand has come down, which you're seeing from the ISM manufacturing, the activity, there's still not as much supply. So yes, prices will come down, but the shortages is going to create that kind of friction that we've talked about in terms of, well, how much supply is available? We're coming back to the 70s when we had brownouts and we had shortages. And even though you were in a recession, you were in a slowdown, you still didn't have enough stuff to bring prices down. And then when you start looking at manufacturing and then the cycles defensive ratio, again, you can see where the market is headed in general. ISM services came in a bit stronger. So now you had the Jolts data, which was good in terms of quantitative easing, or at least pausing rate hikes. And then you have ISM services. Expected at 56, came in at 56.7. So now you're looking at this and saying, well, the market is still elevated. There's still some opportunity here. So why are we going to pause that rate hike, given the fact that this data is still good? The Jolts data is okay. It's moving in the right direction, but still well above where it should be. And then the ISM services employment index 3-month moving average, you get an idea of kind of where some of the different shifts are. Now, when we look at the ISM services beat expectations but declined modestly from August, prices paid. So when you look at, again, the blue of new orders coming down a bit, business prices still elevated, coming down, but again, still high which, and again, anything over 50 is actually expansionary. So yes, it's not rising at the same rate, but it's still rising. And that's, again, the biggest issue. Business employment getting better, back to expansion. So you're seeing a little bit of that, benefit. And one of the things that we've been saying is that manufacturing was going to get hit much harder than services. And you had this big disconnect, and that's why services will continue to be in expansion even as manufacturing continues to slip into contraction. Input prices coming down, again, a net positive in terms of that carry through. Services and consumer prices, typically there is that connection where CPI should start to trend down. But one of the things, which is why we talk about stagflation, is yes, this will bring some prices down, but then you have distillate, then you distillate sales, then you have diesel, then you have gasoline, then you have food, then you have electricity, and that's again going up, which is keeping some of those pieces elevated in general. And that was another key component to it. So then when you look at U.S. manufacturing new orders, came in flat. The trend softening in relative sense, it is the slowest since February 2021. Still positive gains in general, but moving in, again, that slowdown, as we talked about, it's not all at once, but the manufacturing side is still moving down. ISM manufacturing came in at 50.9. The expectation was for 52. So again, exactly what we've been talking about. Services strong, manufacturing weak and getting weaker. New orders fell into contraction and now at the lowest since May of 2020. Production ticked up slightly, prices eased slightly, and employment fell back into contraction and the lowest since June. So when you look at a lot of these key pieces, we're seeing more of that slowdown and more of those leading indicators, new orders, production heading in the wrong direction, showing us the move. Look at new orders. New orders is at 47.1. That's not around 50. That's a meaningful contraction number, as well as when you look at the employment side. So now when we look at new orders minus production spread within September, ISM manufacturing turned sharply lower, negative, back near lowest for the cycle. Construction spending has also weakened, but not to the same level in terms of history. Overall spending is up 8.5% year on year versus residential up 12.4%, both not yet consistent with prior recessions. But again, that's where we see a lot of that those lagging pieces, which are going to get pulled down by manufacturing, by a lot of these pieces that we are seeing that are hitting, that are really those leading indicators we've been highlighting. Just looking at the breakdown in terms of that 52 to 50.9, but what drove it? And you look at new orders, negative. You look at employment, negative. Inventories was a positive, but again, that's still a net negative when you think about, well, inventories are piling up because people aren't buying as much. So even though it's a positive number, it really has kind of that negative pull through when you look at where things are pointing. New orders, as you can see here, steeply down, and now export orders also a big contraction, and this is the first time they've been negative since the beginning, since 2020. So you have to consider, again, now you're getting even a bigger knock-on effect when not only within the U.S. but also now abroad. And that's that contraction that we've been talking about and really discussing to greater lengths. Employment back into contraction, backlog of orders back moving negative. We had a slight uptick, but as we were saying, we saw the backlog coming back down. That's going to go negative when you look at new orders, new export orders. That's where we see more of that pressure. Customer inventories are going back up. So if customers have the inventory, well, they don't have to go out and buy it. And that, again, leads to, more of that leading indicator where the consumer is building inventories. It's still a contraction, but moving in the right direction, which is pointing to more of that slowdown and as supplier delivery times kind of catch up. So then when you look and you kind of put it all together, prices paid have come down, still expanding, but at a much slower level as manufacturing demand slows, but service prices are remaining higher. And as we've been saying, manufacturing prices are going to come down as service prices keep coming up, and they're going to meet somewhere in the middle with U.S. ISM manufacturing prices paid coming down and CPI. But again, the CPI calculation, when you look at housing, rent, and all the other pieces, that's that stagflation we've been talking about, which is why we think that is really where things sit as we go forward. So that's what we have for you on that piece. In the next segment, we're going to go deeper into the consumer as well as following up on some of that housing data.